The £60,000 pension rule sounds very simple. You can put £60,000 a year into the pension and get tax relief. Except for many people, that statement is plain wrong. There are actually two limits you need to understand, and once you separate them, the rule becomes much easier. The first is the annual allowance. For most people, this is currently set to the £60,000 a year. This is the maximum amount that you can put into the pensions during the tax year before you potentially face an annual allowance tax charge. But there's also another limit if you're making personal pension contributions. This is the amount on which you can receive tax relief, which is normally limited to the relevant UK earnings for that tax year. So let's make this very simple. If you earn, let's say, £80,000 in a year, it's high enough to support the £60,000 personal pension contribution, so the £60,000 annual allowance is normally the limit. If you earn £40,000 gross a year, you can't simply contribute £60,000 personally and receive tax relief on all of it. Your earnings are £40,000, so the £40,000 gross is the maximum personal pension contribution on which you can receive tax relief. If you instead earn just £10,000 a year, your tax relievable personal pension contribution is then normally limited to the £10,000 gross that year. The fact that the standard annual allowance is £60,000 does not change that. When I say gross earnings, I mean your earnings before income tax and national insurance have been taken off. We're not talking about the amount that actually arrives in your bank account every single month. Now, there's also a special rule for people with little or no earnings. If you have zero earnings, you can normally still make a personal pension contribution up to £3,600 a year and still receive basic rate tax relief. Now, with a relief at source pension, this would typically mean you put in £2,880 yourself and the pension provider claims the other £720 from HMRC, taking a total contribution up to £3,600. And now we come to another area that causes confusion, which is the carry forward. You may have heard that if you did not use all your pension annual allowance during the previous 3 tax years, you can then carry the unused allowance forward. This is true provided you meet the carry forward rules. So let's just start a new page. So carry forward does not let you ignore the earning limits on your own personal contributions. So imagine you earn £10,000 this year and have contributed almost nothing into your pension during the previous 3 tax years. You could potentially have a large amount of unused annual allowance available, but that doesn't mean you can personally then put in £60,000 into your pension that year and receive tax relief on the whole amount. Your relevant earnings this year are just £10,000, so your tax relievable personal pension is still normally limited to the £10,000 gross. So let's change the example. Suppose you earn a nice £100,000 this year and you have £30,000 of unused allowance from the earlier years. You have enough earnings to support the £90,000 gross personal contribution, and carry forward could potentially increase your available annual allowance from £60,000 to £90,000. In that situation, carry forward becomes useful. So carry forward can increase your annual allowance, but it can't manufacture earnings that you did not earn. This is particularly important for couples where one person earns substantially less than the other. So if one partner earns, let's say, £80,000 and the other earns, say, £10,000, you can't simply treat them as a household earning £90,000 between them and then decide where to put the pension contributions. The personal tax relief limits apply to each individual. Your practical action is therefore to write 2 numbers for each person, their relevant gross earnings for the tax year and their available annual allowance, including any valid carry forward. The lower applicable limit is what matters for personal contributions. So the memorable takeaway from the video is this. The £60,000 annual allowance tells you how much pension saving you may have room for. Your earnings itself tell you how much personal pension contribution you can normally receive tax relief. Hope that clarifies things. Don't forget to give the video a thumbs up and subscribe to the channel. Take care and see you soon.